Oh, I see it now. Yeah, perfect. So we've started recording, so I'll get started. So yeah, thank you everyone for joining this morning. And yeah, this session is being recorded for anyone who can't make it or if you want to watch it back afterwards. So my name is Catherine Barley. I'm the strategic account manager that works with Mohan to support the Julian Harris network from Aviva. So obviously making sure that we're working the best, developing the best relationship we can with you all and making sure you have the support you need. Um, Now, today I'm here to speak to you about the changes to the normal minimum pension age. Now, this is a topic where I think it's been a little bit hidden and missed by some advisors, some firms, because we have had a lot to deal with when it comes to pensions these past couple of years. Last year's big topic was the change from the change of the lifetime allowance moving to the new lump sum allowance, and then this year we have the fact that pensions are going to form part of people's estates, hitting all the headlines, and they're real big issues. But what's happening is the changes to the normal minimum pension age are getting a little bit missed because of those big topics. And the fact that the normal minimum pension age doesn't change until 2028, most people think it's fine. We don't need to deal with it now, which is perfectly understandable. But when you actually look into the detail a bit more, you'll realise actually there is reason to consider it now and understand now what you need to be looking at. Especially because obviously consumer duty is still high on everyone's agenda, and the changes to the normal minimum pension age are especially important to consider in line with consumer duty cross-cutting rules. Um, because once we highlight the details and considerations that you need to be aware of, it'll help you towards acting in good faith towards your clients, and highlighting the impact that this will have on your clients will help you to avoid causing foreseeable harm. So all of that will become a bit clearer when we go through the presentation. So today really we're looking to get under the skin of the normal minimum pension age and what it means to the advice you're giving your clients. And we're going to have a look at the background, what's led to these changes, um, the detail of what's actually taken place, what it means for your customers, and the detail that you need to be aware of now to make sure you're giving your clients the best advice possible. So I should also say, if you've got any questions, feel free to ask them throughout. But I think what I find throughout this presentation, which when I have presented it in the past, a lot of questions do get answered throughout the presentation. So maybe if you save them till the end, if there's anything that I haven't answered throughout the presentation, then I'm happy to take questions then. I think this is scheduled for an hour. I expect it to take about 45 minutes, and that's still giving plenty of time for questions as well. So first, let's take a look at the background and how we've gotten to the point we're at now. So ultimately, all of the changes to the normal minimum pension age are driven by previous government decision making. So since we had the coalition government, however many years ago that was, there has been great concern over the government's pension budget. And you can kind of break that down as four different problems, which all relate to greater life expectancy. So first of all, you've got the state pension not increasing in line with life expectancy. When it was first set up, it was intended to see people through the last few years of their life when they were physically no longer able to work. But now you're likely to see clients having 30 or more years in retirement, which is obviously causing a lot of strain on everyone's pension budgets. Um, in addition to that, we've also seen a significant decline in private sector pension provisions and an increasing reliance on the state pension for retirement income, which right now, looking at recent statistics from the OBR, it's the second largest state benefit expenditure in the UK. So currently, I think the latest statistics show in 2024-2025 tax year, it was at 138 billion, which was the cost of the state pension. And that was the second largest item in the government budget after health. And that equates to around 5% of GDP. And the OBR are projecting the costs will rise to 7.7% of GDP by the early 2070s. And one of the most significant factors behind that huge projected increase is due to the cost of the triple lock guarantee. So the OBR are estimating that operating by the triple lock rather than by earnings will have added 15.5 billion to state pension costs by 2029-2030. Now, if you had looked at increasing that by in line with earnings rather than by the triple lock, there would be a saving of approximately 15.5 billion each year. So obviously there's a lot of conversation happening around that. There's a lot of pressure, with the cost of that to the government. Then, so that's looking at the cost of, the state pension now. But when we look back at what's led to the changes to the normal minimum pension age, one of the additional factors that led to that was pension freedoms. So you've probably, if you're like me, I've been working in this business for 17 years, and a good chunk of that was with pension related stuff, retirement related stuff. So I was around in Aviva when pension freedoms came into play. And I'm sure a lot of you would have been around then as well. And at that point in time, we saw a lot of big headlines when pension freedoms was being introduced, and there was a lot of concern about clients potentially going to fully withdraw their pensions. There was talk about, what they might go out and spend their money on, and headlines that were saying people were going to go out and buy big Italian supercars. And I think we had Steve Webb quoted as saying, if people do get a Lamborghini and then end up on the state pension, the state was much less concerned about that, and that was their choice. So obviously that was, causing a few raised eyebrows and concerns at the time. But what we actually saw was clients recognizing the need for advice, and qualified advisors like yourselves became really important to clients when it came to considering what to do with their pensions. And we obviously know that you play a key role in helping them try and preserve those pensions to see them through their retirement and potentially beyond. Obviously, a lot of it was considering passing it on to their loved ones. Thoughts are going to change on that going forwards with the recent changes that are going through. So yeah, those were the sort of things that led to the background of what's changing now. So looking again then at with these issues in mind, the government made some changes over the last decade or so, probably more than a decade ago now. So to address the problem, they had to come up with a bit of a plan. And in summary, the solutions that they came up with were auto-enrollment, so making it a default for clients to save, which would then have a long-term impact. They wanted to achieve gender parity on the state pension age, and that's something that also addresses the issue around greater life expectancy as a side effect. They set out to increase the state pension age, which will eventually be 68 in line with life expectancy. And then most recently, and the reason I'm here to talk to you today, is the increase to the normal minimum pension age in line with the state pension age minus 10 years. So in line with that, it will be changing to 57. So why do I feel this is important, and why do I feel you need to be aware of some of these details? It could be really easy to overlook. We've heard of lots of different scandals over the years. We've got the British Steel scandal, where unsuitable advice has led to many clients losing valuable defined benefits. And then we saw the WASPI scandal, where women impacted by the change in the state pension age have lost years of income with insufficient time to suitably plan for their retirement. So, what do those scandals have in common? A lack of knowledge, which has impacted a client's retirement, and insufficient time to plan ahead, because in some of those instances, there was no one anticipating the foreseeable harm to those clients. And we're in a position now where our technical experts at Aviva have looked at this change in legislation inside out, and we're now armed with the knowledge and sharing it with you so that you can then be suitably armed to help your clients plan ahead for their retirement and make the most of any benefits they may have access to. And we all have a part to play. We don't want this to become another big scandal, and it's up to everyone to ensure that clients are receiving the best possible outcome. So this may be an additional consideration you need to make when transferring and consolidating your clients' pensions across the markets, and this knowledge will help to avoid any foreseeable harm when it comes to your clients' retirement plans. Um, we all know when you first sit down with your client to help plan their retirement, a lot of clients, while they would love to retire at age 55, they might have planned to retire at 55, they might not have, but whatever plans they make at that outset, at that first meeting with you, we all know that things change. Life events happen, such as marriage, divorce, death, serious illness. These things, they all change the path of your client's retirement plans, which might then lead them to needing access to their benefits earlier than planned. And so, do you need to then incorporate these changes and these considerations into your requests for information and your suitability reports? Do you need to relook at your cash flow planning with your client? You might need to look at your client bank to identify those clients that might be impacted by these changes. And do you have clients who are lucky enough to have planned to retire at age 55 who might now be impacted by these changes? So there are just a few different things I wanted you to maybe be thinking about throughout this presentation. As we delve deeper into the detail, some of those things might then twig with you to say, actually, I do have a client that might be impacted by this. Let's take a look at it after. So let's have a look at the changes that are actually taking place. So for anyone that loves detail, the Finance Act 2022 is a document with lots of detail related to this, and feel free to read that at your leisure afterwards if you want to actually dive into that detail. But for those of you who don't have time to read through lengthy documents such as that Finance Act, I'll summarize it. So specifically within the Finance Act 2022, it's point 10 of that document that sets these changes into law. So it realizes the new normal minimum pension age, raising it to age 57. And it's also set out the date that the changes take effect, which is the 6th of April 2028, which is a key date that you'll need to remember. There'll be one or two other key dates I may go throughout this presentation, but that's one that you need to remember alongside others that I'll cover later on. Now, within that act, there's protection given to existing access rights. So, for example, to the uniformed professions. So that's an important point to note for those of you with clients in professions such as the armed forces, police services, fire service, etc. But for anyone not in any of those protected services, professions, then there'll be some changes that will affect them. So you might be tempted to think it's not changing until 2028, so I don't really need to think about it now. But I want to really underline that, we shouldn't be tempted to fall into that trap, because whilst the 6th of April 2028 is the date when the normal minimum pension age changes to 57, the changes actually potentially affect anyone joining a pension scheme after the 3rd of November 2021. So that's quite a few years ago now. But if you have someone that's joined a pension scheme in recent years, you need to remember that date also, because there's a key difference if they've joined the scheme after the 3rd of November 2021 versus if they joined a pension scheme prior to that date. Because at that time, there was, when this was all taking effect in November 2021, there was actually a transition period that was going to be implemented, but then they did a big U-turn on that and didn't really give anyone time to do much about it. So 3rd of November 2021 was the date then it all took effect without any transition period. So to make it a bit easier to understand, clients who haven't reached age 55 by April 2028, the changes will impact them. And it's good for you to understand now how the changes will impact them in order to shape your advice and your client conversations going forwards. So I'm going to take you through some examples. So basically, the examples I'll take you through initially, first of all, assume that your clients are outside any protected schemes. So this will be the generic market position. And then further on, I'll take you through the Aviva position, but also that will relate to any schemes that have a specific protection in place. So there'll be key differences with schemes with the protections and without. So first of all then, let's take a look at the general market without any protected schemes in place. So anyone that's an existing scheme member, those that are born before the 6th of April 1971, there will be no impact because they'll already be 57 by the time the changes take effect. So those clients don't even need to think about it. But for anyone that's born after the 5th of April 1973, the normal minimum pension age is now 57 according to the changing legislation. So again, this is just the general market position. Those clients who might have originally set out thinking they could take their benefits at age 55, because of these changes taking effect, it will now be 57. Now, there's a little window of clients where you might notice I talked about 1971 and then I talked about 1973, but those clients who are born in between those dates, they'll be able to access their pensions on their 55th birthday, all the way up until the 6th of April 2028. Now, if those clients don't crystallize, they will then have a normal minimum pension age of 57 after the 6th of April 2028. So if we look at the more extreme scenario for that window of clients, if you have a client who turns 55 on the 1st of April 2028, on that day, they'll be able to access their pension according to current legislation. However, if they don't act within those few days, in a few days later, on the 6th of April 2028, the legislation changes, and all of a sudden they have to wait a further 2 years before they'll be able to access their pension. So there might be some clients that are in for a little bit of a shock. So if they're expecting that they turn 55 and can access it, those are the clients that you might want to have a look at within your client bank to see if any of them were born within those 2 dates. So the window of clients between the 6th of April 1971 and born between that date and the 5th of April 1973, those clients will be impacted in that way I've just outlined. So the sort of things you can do now to prepare them, if they plan to access their benefits at age 55, you might need to have a more of a plan in place for acting quickly to crystallize their benefits if they do want access to them at that age. Or if they don't plan to access their pensions, Are they sure that their financial plan allows for any unexpected life events in that period? Because they'll have to make sure that they're going to be financially secure until at least age 57 if they don't plan to access it within that small window. Another question we frequently get is, can a client partially crystallize their funds to retain access at age 55 for those small window of clients? Now, any funds that are crystallized at age 55, when they reach that age and are able to access them, they'll be able to access any of the crystallized funds from age 55 onwards. But any funds that remain uncrystallized within that small window, that will then move to 57 for access to those funds. So there's some considerations there. We have some advisors who choose to crystallize a small portion of the funds, so they do have a small pot to access if it's needed. And then some just use other assets to buy them some time until age 57. But it's those clients that are expecting to access at age 55. They're the clients that really need to understand what's changing and how they're going to be impacted, and maybe adjust their plans. So, and then finally, as we've already said, any new scheme members, they will all be technically written with a normal minimum pension age of 57 from now on. So from 2021 onwards, anyone joining a new scheme, it's automatically going to be at age 57 when they can take their benefits. Um, so, do you think your clients are aware of this change in legislation? Because it's getting hidden amongst a lot of other big pension headlines. And this is the sort of thing that clients might not be thinking of. Your clients are probably busy with lots of other things related to their own work, personal life, etc. This is the sort of thing, unless you've got clients who love looking at the detail of their pensions and what's changing, a lot of clients will have missed this. Um, and just to underline some of this as well, at the time when we put this presentation together, we had a look at some of our own statistics within our Aviva pension assets. So we have probably close to 50 billion of assets on the platform, and I think it's probably 30 something billion of those are pension assets on the advised platform alone. And when we look at these, we've seen that 18.45% of these clients have accessed their pension to some extent between the ages of 55 and 57. And that could be anything from a small amount of tax-free cash, or setting up a regular income, or one-off larger withdrawals. Whatever that may be, we've seen those pensions access to some extent. So if we're seeing 18.45% of our clients accessing their pensions between the ages of 55 and 57, it just makes me wonder, is that representative of your own client banks potentially? Would you potentially see your clients accessing their pensions between those ages? So just something else to have a think about with your own client bank. So moving on then. So I have just outlined the changes that are taking place and the clients who may be impacted. But here at Aviva, there are some key differences to consider. So the Aviva Personal Pension Scheme, which is the scheme that covers the Aviva platform pension, but it also covers some of our non-platform pensions. So we have, some legacy assets that are still part of this Aviva Personal Pension Scheme. Now, this pension scheme has an unqualified right to access benefits at age 55. So what that means is, we are one of, I think there's another provider in the market that has their scheme written in this way, but when we wrote the rules of the Aviva Personal Pension Scheme, we wrote it in a certain way that gives clients an unqualified right to access their benefits at that specific age, 55, whereas the majority of other schemes in the market have been written in a different way, so they do not have this unqualified right to access. So that's a key question to ask of any clients within any pension schemes. Those pension providers, those providers of those schemes, the key thing you want to be asking them is, does their scheme have an unqualified right to access benefits at age 55? And that will tell you whether or not they will have the same sort of rights that this Aviva scheme has. So if I just focus on the Aviva scheme, but bear in mind there may be others in the market that have similar rights to access. So I think what this means then is a scheme member has an unqualified right to take benefits if they do not need the consent of anybody before they can take their benefits. And if the scheme documentation states that the consent of the trustees or employer is required to take benefits, the member does not then have an unqualified right. So that's just saying it in a more technical way. It doesn't matter if the trustees operate their discretion to allow the payment of any benefits, the right is still not an unqualified right. So that's really outlined in a technical way what that unqualified right means. So, and our Aviva personal pension scheme has been written in a way so that members do not need any consent, and that's the key difference. So again, at this point, I just encourage you to go to any of the pension providers that you normally work with and ask those specific questions about whether or not their scheme has the unqualified right to access benefits at age 55. So I've already mentioned that the Aviva personal pension scheme covers the Aviva platform pension and a number of others. And I'll come on to how you can identify what pensions fall within that scheme shortly. So if you think that any of your clients may hold a pension within the Aviva personal pension scheme, this is how they'll benefit. So existing platform clients will have access at age 55 if they joined before the 4th of November 2021 and held a monetary value within their pension before that date, and that's regardless of their age. And this is the same for any non-platform pensions which are held under the same scheme. So the protection operates at scheme level rather than individual level. So this means it also allows movements of funds between accounts under the same scheme, which I'll go into further detail on this shortly. So first, how do you identify which of your clients are within the Aviva personal pension scheme? We'll take a look at that on the next slide. So we can share this after this presentation, but we have this detail here which outlines the different Aviva pension policy numbers. So you'll have various ones. You'll be familiar, if you're familiar with the Aviva platform, you'll know the Aviva platform pensions start with AV. Then we've got some schemes that start with TK, TL, PP and PW. So if you've got a policy number starting with those letters, then the next questions to ask or to have a look at the detail of the policy is, did your client join that scheme before November 2021? And if so, did their pension hold a monetary value before that date? If the answer is yes to both of those questions, then they will benefit from this unqualified right to access at age 55. If the answer is no, then it will be moving to 57. So that table is found on our website, but we will make sure this is shared with everybody afterwards as well. So then I'm going to take you through a number of specific Aviva examples now. Now, whilst I'm looking at specific Aviva examples, if there are other pension providers, pension schemes that your clients are part of with other providers, then these points and these scenarios may also apply. But the important thing is they need to have that unqualified right to access at age 55 in order for these scenarios to be relevant. So looking at example number 1, if the client is new to Aviva and they've decided to consolidate all their pensions, none of which were previously with Aviva, and they had no protection within their seeding schemes, the normal minimum pension age is going to be 57 according to the new legislation. So that's a straightforward example there. But yeah, again, still important for your clients to be aware of that change in legislation and to make sure that they have a plan in place for it to be 57 rather than 55 for them to access their pensions. So moving on to example number 2. So I'd ask you to maybe have a think about any customers you might have who might already hold an existing Aviva platform pension. And if you keep that client in mind, if their pension started before the 4th of November 2021 and it held a monetary value before that date, they will then benefit from the unqualified right to access at age 55. So, do they also have another pension held with any other providers? If they're looking to consolidate the two, let's say they do have a pension with another provider, if they transfer that external pension into the existing Aviva platform pension, the whole fund will benefit from the unqualified right. So that whole fund will then be accessible at age 55. So let's use a slightly extreme example. So let's say your client's Aviva platform pension holds £100, but because it was set up prior to November 2021 and that £100 monetary value was held before that date, um, that's enough for them to still have this protected age of 55. They could then transfer in any external pensions. So let's say they had 250,000 held with another provider. They could transfer that 250,000 into that existing plan, which holds £100, and the client will then be able to benefit from accessing the full amount, the 250,100 at age 55. Obviously, hoping it'll grow before then, but that's just using an extreme scenario to underline how your clients might be able to benefit. And again, similar to that scenario, that's just looking at an Aviva pension. But if you've got another provider who has the same protection, then it should work the same way. But always check with the other providers for their stance on things. But this is our understanding of the legislation according to our pension scheme rules and how it should apply to any other schemes who also hold the unqualified right. So hopefully that's something for you to think about there. So can you identify any of your clients holding an Aviva platform pension who also hold pensions elsewhere? And is there something for you then to think about and speak to your clients about at their next review? So that's example number 2. Moving on to example number 3 now. So this time, let's think about a client you may have who has a non-platform pension with Aviva. So some of those other policy numbers I highlighted earlier, let's say they begin with PP, TL, TK, those kind of policies that are not on the Aviva platform but are still part of the same scheme. So let's say you check and you find out that it's one of those previously listed and it's within the personal pensions, Aviva personal pension scheme, and you then find out that it was opened prior to November 2021 and it did hold a monetary value. Because the protection is at scheme level, that means this client can move their pension to the Aviva platform and will retain the benefit of this unqualified right to access at age 55 because they're still keeping it within the same scheme. They're just moving it to a different contract within the same scheme. So it's also given them another option to consider. If that current pension that they're in, one of the older style pensions potentially, if that's no longer meeting their needs, then it gives you something else to explore by upgrading it to the Aviva platform potentially. So again, another thing for you to think about here. Do you know how many of your clients hold pensions within this scheme that aren't on the platform. If you speak with your Aviva account manager, whoever that is, hopefully you do know who your Aviva account manager is. If not, then feel free to get in touch and we'll make sure someone is there to support you. But whoever your Aviva account manager is, if you get in touch with them, they'll be able to request the data on what clients hold Aviva pensions within this scheme and then be able to have a more in-depth conversation highlighting which of your clients are impacted that will be able to help you highlight. So moving on to example number 4. So similar to the last example, so if you think of that same client who holds a non-platform pension with Aviva, so again, one of those off-platform pensions that are within the same scheme, and if again you've established that that pension can be accessed at age 55, this time you might also identify that they have pension assets elsewhere, which you may want to look at consolidating. If your client moves the non-platform pension to the platform along with those other external pensions, the whole amount again will benefit from the unqualified right to access at age 55. And I should also mention that any regular or single contributions made after that point will also benefit. So really, once we've established that it's within the right scheme that has that unqualified right, it was set up at the right time with a monetary value, that anything that follows and joins those existing assets that have established that right will also benefit. And one point I made earlier in the presentation, which I'm going to make again just to really underline it, so apologies if I'm repeating myself. I'd just really like to encourage everyone to reach out to all your pension providers to check whether or not their scheme rules contain this unqualified right, because it's a really key point to know when you're advising your clients on their futures. Just to help you identify as well, just so you know which of those can be accessed at 55 and which can be accessed at 57, and how will they be impacted if they transfer. Moving on to example number 5 this time. So this time I'll ask you to think about a different customer who has a pension held with another provider who gives them a protected pension age of 55. I know there is at least one other provider who also has this unqualified right to access, and I'm not afraid to say that I believe that's Fidelity, but again, I'd encourage you all to check with those other providers because they'll have their own technical experts who have all the detail on their own schemes, but we know there is at least one other provider out there with this same unqualified right. Now, if you determine through your own research and comparisons that the client could still benefit from moving to the Aviva platform, and even though they have that protected pension age of 55 with that other scheme, if they intend to contribute further or they might have other pensions they want to transfer in with it, they might still benefit because with the Aviva platform, we can ring fence any protected age. So where it's transferring from a scheme that actually also has the right to access at age 55, then we can ring fence that. So, and the important point to make here is that where they're a new customer to Aviva and were not within the Aviva personal pension scheme, they did not establish any protection through our scheme. But what we're doing is where the transfer is coming from a scheme that has that protection, we're then ring fencing that so they can access that at age 55. Now, any additional non-protected pensions or any additional contributions to make further down the line, that will be held outside of those ring-fenced assets. So in that scenario, you might have multiple transfers that have come into the Aviva platform. If one of those transfers had the right to access at age 55, that fund will be ring-fenced to retain access at age 55, but any additional transfers will then be accessible at age 57. So you could have a client that ends up with separate ring fence pots, but because one of those pots might have been ring fenced for access at age 55, they still have that benefit retained, but only part of their pension can be crystallized at age 55 sooner than the other part. So again, that leads me to another important questions which you might want to ask your pension providers, which is, can they ring fence pensions which have a protected pension age of 55? Now, I can't say for any other providers whether or not they can do that, but it's an important thing to be aware of. If you've got a pension where there's access at age 55 that's protected, and you're looking at moving it to another provider for whatever other various benefits there might be, a key question to ask is, can they ring fence that benefit so that the client can still access at age 55? Because otherwise, if the client can't, or if the provider can't ring fence, then if you transfer away, you're potentially going to lose that right to access. And then this final example, again, just highlighting what I've just mentioned. It's highlighted in red because there's a potential danger which we want you to be aware of so that you can avoid it if it's something that's important to your client. So if your client holds a pension within the Aviva personal pension scheme and benefits from the unqualified right to access their pension at age 55, if they transfer away from that scheme, they're at risk of losing this benefit. And the only way they'll be able to keep it is if the receiving scheme also has an unqualified right to access at age 55, in which case then they can keep that protection in place, or if the provider can ring fence the benefits. So this is why I keep saying there are some important questions for you to ask the providers that you work with, just so you can understand the scenario for each of your clients, and just ensuring that there's no foreseeable harm. Because if there's a scenario where transferring away may lead to a client losing a right to access at age 55, which they may be able to retain elsewhere, some clients might find that access valuable and might not want to lose it, and that might be where the foreseeable harm could happen and which we want to try and prevent. And you might have a scenario where, okay, access at age 55 is not important to your clients, but at least then you've been able to identify and highlight the detail to them so they can fully understand the impact of any transfer away from a scheme such as the Aviva personal pension scheme. So at this point then, before I move on to the next slide, I just want to summarize the key points that I want you to take away today. So we've got the key dates of the 6th of April 2028, which is when the change actually takes effect. Then we've got the 4th of November 2021. Any new scheme members from that date on will automatically have a normal minimum pension age of 57. But prior to that date, there's potential that they could have some protection in place that you might want to investigate. And some questions then to ask all providers again, does their pension scheme have an unqualified right to access benefits at age 55? And can they ring fence any pensions which have a protected age of 55? And some points to think about within your own businesses, which of your clients will be impacted, and what parts of the advice journey need to be revisited to address these changes. So we know then that there's some benefits of being within the Aviva personal pension scheme, but what else could we be thinking about? So let's look at these non-platform clients within this scheme. Those contracts may have been, great contracts and might still be great contracts, which are still suitable for your clients or were suitable when they were first taken out. But could your clients benefit from an upgrade? So, do you need to carry out a value for money assessment to see if your clients could benefit from an upgrade to the Aviva platform? We know some clients can move to the platform and retain access at age 55, but what else might they benefit from? Some of those older style contracts that they might still be holding might have flexi access drawdown, but there's probably some limitations within some of those contracts. So would upgrading to the platform give your clients better access and more flexible access to drawdown, where they can access regular automated income, ad hoc withdrawals, and more. Would they benefit from a greater range of investments on the platform? Because we know some of those older contracts have a more limited range of funds. And, is there a benefit to you as an advice firm by upgrading your clients to the platform? It will give you greater online functionality, helping you to manage your clients' investments more efficiently and make better use of some back office integration. So a few extra things, that the Aviva platform can provide you and your clients. So just some thought to give there about those clients who might benefit from being within the scheme, but could benefit by greater access to functionality on the Aviva platform if you were to upgrade their pensions. So just something to have a bit of a think about. Your Aviva account manager will be happy to talk about any particular clients in more detail and whether or not they can compare and whether or not there'd be a benefit there for you to consider. So at the start of the presentation, I highlighted some things that I wanted to help you understand. So hopefully you now understand the background of what's led to the changes to the normal minimum pension age. Hopefully I've repeated those key dates enough times that they're embedded within your mind, and hopefully you now understand how this might impact your customers and why it's important for you to know the detail now, to help you be armed to have a look at your client bank and have those client conversations to prepare them for what changes are about to take place. And I'm hoping you've all taken something away from this and feel better armed with some more knowledge now and are able to put that to good use with your clients. I did expect this to take 45 minutes, so apologies I've overran, but we have this scheduled for an hour and we still have more time for questions. So if anyone does have any questions, now is the time to ask them. If you've got anything in the chat or if you want to raise your hands and speak up with your question, I'm happy to take them either way. Do we have anything in the chat at the minute, Mohan?
There's nothing in the chat.
Okay. Anyone have any questions, or have I given enough detail to answer any questions you might have had? Okay, we take that as a no for questions then, unless you see anyone typing away there, Mohan, or do you have any questions yourself or any thoughts on that?
No, that was great, Catherine. Really appreciate that.
Okay.
Very informative. So if there's no more questions, we'll send this out recording to all the other advisors as well.
Perfect.
Yeah.
And yeah,
Thanks,
again,
Catherine.
we've got.
Oh.
Sorry, I'm talking over somebody. Apologies. Someone was speaking.
No, I was just saying thank you, Catherine. That was very useful.
You're welcome. And again, if there's any questions that do crop up afterwards, we've got our team of account managers who are happy to talk about cases in detail if needed. And yeah, come through to me if you have any questions also after this, because if you don't know who your Aviva account manager is, I'll happily get you in touch with someone just to make sure you're all getting the support you need from us here. And we'll share some of the detail of this afterwards as well. Okay, I'll let you all get 10 minutes back then, and thank you for your time this morning.
Thanks, Catherine. Take care.
Bye.
Bye-bye. Bye-bye. Bye.